Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer of SilverOak. And with me today, as usual, is Jonathan Charlo, also a partner and our lead analyst. Our webinar today is scheduled for 45 to 60 minutes. After the webinar, we will post a copy to our website. If you have any questions throughout the webinar, I really encourage you to reach out to your SilverOak advisor. If you're not working with a SilverOak advisor, feel free to contact me directly at 952-896-5701. And of course, I want to thank Jonathan and the rest of the team who put the materials together. I think I've said multiple times that it does take a village. It's a lot of data. It seems simple and easy, concise when we go through it, but that's only because we worked really hard, hopefully to make it seem like that. But there's a lot of effort that goes into it, and also on our technology side. So thank you for everybody involved. For compliance purposes, I do need to note we'll be discussing the overall markets and economy during today's webinar. In doing so, we're providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we're not going to be discussing specific SilverOak portfolio performance since each of our clients' portfolios is customized, but all of our clients should have received their quarterly performance reports by now. If you have any questions, feel free to reach out to your advisor if they've not already reached out to you. And lastly, past performance is no guarantee of future success. So, with that, Jonathan, let's go to the agenda. I think we're going to start, as we typically do, around the economy and just talk about what's happened, look at the dashboard, go through the various components there, and then transition into our discussion on the markets, mostly what has happened over the last quarter or year to date, but then we'll transition into what we think will be happening in both the economy and the markets moving forward. Of course, our crystal ball is just about as good as anybody's, but nonetheless, we'll give our educated assessment of what the future is going to look like. You've added a topic here, Jonathan, financial planning in retirement. I suspect this is a very popular topic, particularly those either close to retirement or maybe in retirement. Hopefully a lot of our clients have got this nailed because we're doing it for them.
Absolutely.
But nonetheless, we'll talk through some of the pitfalls and things to be mindful of. We'll go through some SilverOak updates. That will be relatively quick. And then, of course, we encourage you to ask questions. I know this is not per se live, but you can always reach out to your SilverOak advisor with questions or even topics. If there's topics that you want us to add, we are very, very happy to receive those suggestions. So let's start with the economy and the dashboard. What would you say overall, Jonathan?
I think we'll see in the upcoming slides that there haven't been a lot of changes, certainly not to the dashboard. We've seen a little bit of improvement, but we'll see not a lot of actual changes. And obviously the economy continues to chug along. Certainly we'll talk about the labor market. That's certainly an area that has weakened a bit, but most other factors have been roughly the same.
Got it. So if we look at the dashboard, and again, just to remind everybody, the dashboard is broken into a couple of different components. The first component of the dashboard is the economy. And what you're seeing, each of those squares represent a different quarter, going back to, on the left, the third quarter of 22, and on the right are projected of fourth quarter 25. Green, the darker the green, the better. The darker the red, the worse. And gray is kind of neutral. So we're saying right now, from an economic perspective, we're kind of in that neutral territory. But we actually have it projected anyway to get slightly positive.
And this expectation is kind of what we thought last quarter. So we thought it would be about neutral this quarter, which it has. And again, we also thought the fourth quarter would be improving.
Okay.
So.
But not a lot of change. Credit markets, they actually did improve. They were neutral, they weren't bad. They've slightly improved. Now, we'll talk a little bit later. I mean, just within the last few days or week or so, maybe there's been a little bit of turmoil. I wouldn't say broad-based turmoil in the credit markets, but I think there was a auto part manufacturer that declared bankruptcy that sent some concern through the private credit markets. But so far, what we're seeing here is positive.
Mm-hmm.
Valuations. Boy, this is a broken record.
Yeah, they just continue to be high, but we've always said that valuations isn't really a timing tool. And,
Yeah.
on the other hand, this year, and you'll see that as earnings have been coming up.
Yeah.
So.
And just to point out, valuations are red, meaning bad, in a sense that stock market's done so well, the valuations are high relative to history. Market sentiment actually shifted quite dramatically. It went from quite positive in the first quarter to really negative, back to really positive.
And we've seen that in the stock market this year.
That's fair. That's fair. So the overall composite, once we bring all of those various components together, remains in the neutral category. And you'll see that here on this chart, that, you know, in that gray area, that's kind of that neutral area, as the black line and forgive me, but the other line, yellow line, as they progress upward, they'll then break into, hopefully, the more positive category as we look forward. But right now, it's really the dashboard composite, but the 6-month average is still a bit below.
So it's still gray, but it's almost a little bit of a better gray than last quarter. We're getting closer to the upper end of the channel.
Trajectory's the right direction.
Correct.
Got it. So there's various components to that dashboard, as we just discussed. And one of the kind of subcomponents, when we look at the economy is actually made up of 24 factors. One factor is this ISM index. What's this showing us?
Well, it's showing that we're kind of bouncing along. And if we look at the black line, that's manufacturing. That had come up nicely and has kind of come down a little bit. When we look at the service, that's kind of come down a little bit. So on the margin, things have weakened a little bit. But I will note that some of the international PMIs actually look like they're improving a little bit. So overall, still signaling things are fine.
Yeah, but right at that break point, so the red line here is 50. If it's above 50, supposedly expansionary. Below 50, it's contracting. And we're kind of right at that, between the expansion and contraction range.
It's certainly something we'll want to watch.
Got it. Employment, which is another one of the 24 factors under the economy section, excuse me, of the dashboard. What's happening here?
We've actually seen unemployment tick up a little bit. And in general, if we look at the jobs numbers that have been reported, they have been weakening. And so that's certainly a factor that the Federal Reserve is looking at. They've started to lower interest rates again. While inflation still might come up a little bit, and we'll address that later in the webinar, it seems like the Fed is now focusing on this part of their dual mandate.
Got it. Got it. Well, and we'll mention this later, but with the government shutdown, we're not really getting the same data that we used to. So it's going to be a bit of a surprise once things do restart as to where the unemployment has been the last couple of weeks.
Yeah, and we could see a little bit of volatility due to that, because they're looking at private market sources, but again, that's a different methodology.
Yes. Yeah. Another component or factor of the economy in the dashboard is housing starts.
Yeah, and we've been kind of slogging around. If you look at the black line, that's really more of the 6-month average, and that's been kind of flattish. When we look at year-over-year growth, it looks like maybe it's starting to improve. Certainly, the fact that the Fed is lowering interest rates should help the housing market, but in general, the housing market has been more on the weak side for the last 2 or 3 years.
So let's transition from the economy, at least the economic component of the dashboard, excuse me, to the credit markets. And this is the yield curve. What is it showing us?
What it's showing us is it had been inverted or below zero, and that's been kind of coming up. And if we look at that greenish line, what it's saying is that the 10-year Treasury yield is higher than the 2-year, and that's good. The only thing a lot of people are watching is if you look back in prior cycles, you actually saw it increasing while there was a recession. And so some people have said, maybe that's why we have a recession risk when you look at what's going on with the labor market.
Got it. High yield spreads?
Well, this has, been something, I think we've been a little bit astounded with, is that, despite the policy uncertainty this year, when we look at spreads for high yield and investment grade corporate bonds, those have come down. Mm-hmm. And usually that would be the canary in the coal mine, so to speak. If things were truly weakening, investors would start demanding a higher yield to take on that risk with corporate bonds.
Yeah, and that kind of speaks to my comment earlier with private credit concerns with this bankruptcy of the auto parts manufacturer, and I think there was an auto lender the week prior that went bankrupt as well.
And we've certainly seen auto loan delinquencies have gone up, so that's not completely surprising.
Valuations. So this is another component of the dashboard. What's going on with earnings?
Well, earnings have been strong this year. When we look at Q3 earnings, they're projected to be up almost 8%. That would be nice. It would be the 9th straight quarter in a row of earnings growth. It would be down a little bit from last quarter, but we also are taking the estimates for next year, and that's what you're seeing in the green bars.
To the far right.
To the far right. So that's suggesting that while valuations are high, they're not getting higher because essentially earnings are coming through.
Yeah, I always like to explain this to folks. Earnings and valuations and how they interplay. I think of it like a staircase. Valuations take the first step up, and then they kind of wait to see if earnings catch up to them. And if they do, then the valuations will take the next step up on the staircase and wait to see if earnings catch up. And that process really is what drives the stock market over time in that upward direction. But occasionally, the earnings don't justify the valuations, and then valuations got to take a step back, or, in some cases, 2 steps back. All right, let's take a look at market sentiment.
Yeah, and that turned very positive. And we've talked about this in the past, but this is showing the S&P plotted against the 200-day moving average, which is in orange, and the 50-day moving average, which is in green. And so when that longer-term moving average is moving up, that's very bullish. But at the same time, when that 50-day crosses below, that's kind of seen as bearish, and we certainly saw that back in 2022. And then it did come down in the April period, but then quickly came back through and now is moved up, and the market is much higher. Again, valuation is high, but from a sentiment standpoint, momentum is said to beget momentum, and so it's a very solid situation right now. It's not to say that if earnings don't come through or some other shock comes through that the market couldn't come down, but there is a lot of momentum currently.
Got it. All right, let's transition then from kind of the market dashboard discussion and big picture economy to the actual market performance itself. And what we're going to show here are third quarter performance numbers across the major equity sectors, starting at top with US large cap, and then going into mid cap, small cap, internationally emerging markets. And across the board, obviously, a really, really strong quarter. Year-to-date numbers look great as well, and these are not annualized. They're literally just year-to-date numbers. One thing to point out is down on the international, internationals ex-US, US dollars, up 26. But in local currency, so these are foreign currencies, up 17. So what we're saying there is, you take those foreign currencies, you convert them to US dollars, and you've got about a 10%, or at least almost 10% benefit from that conversion, because the dollar's really low right now. I was a little bit surprised to see that differential, or the benefit for the low dollar, to be not quite as high in the emerging markets. But it just doesn't seem like the US dollar is quite as weak against some of those emerging currencies.
It has definitely been weaker against the euro versus other emerging market baskets of currencies.
On the next page, we have, again, same third quarter data, but this is for bond-oriented assets, commodities, and REITs. And you're going to see the Bloomberg US Ag, which kind of measures the US broad-based bond market, had a pretty solid quarter. I mean, 2%, again, is not anything compared to some of those equity numbers, but that's not the purpose of bonds. I mean, that'd be like saying you just bought a Ford utility truck to, race in the Indy 500. I mean, they're different purposes entirely. And year to date, I mean, bonds being up 6%, that's pretty solid, because that's not even annualized. If the trajectory continues, and if rates, fall a little bit further, I could see a little bit more upside there. Let's talk about style returns. So in each of these sectors within the US, large, mid, and small, some stocks are more value oriented. Think of, I don't know, industrials and banks. Some are a little bit more growth oriented. Think of, mostly technology. So which over the quarter have done better in each of the sectors?
So if we look at large cap, growth definitely did better than value. And again, I think that's because of technology and the Mag 7 stocks. But actually, when we look at mid and small, value actually did better in mid cap and just slightly better in small cap.
For the quarter.
For the quarter.
Yep.
And I think that's just speaking to the fact that we're seeing a bit of broadening in performance.
Got it. But clearly, I mean, it's still, for the year, large cap growth is pretty much dominating.
Yes.
And growth generally is dominating. How about sector performance within each of these?
And I think this is where we can really see that. This is looking at the large cap sectors. So if you look at technology, communication services, both up double digits, consumer discretionary up 10%, that is really what drove growth within the large cap.
And those are all on the bottom, more growth oriented.
Absolutely.
Got it.
Now, if we look on the top, you're going to see consumer staples actually was negative in the quarter. You're going to see energy was actually pretty decent, and utilities, probably surprisingly, was the top performer. Now, most people think of utilities as being safe, but I think what we're actually seeing here is we've definitely, with the increase in data centers in the last couple of years, we've actually seen electricity demand increase. And so the stock prices of the electric utilities have done better as a result.
And I mentioned the international performance before and how strong it was, especially once we converted to US dollars. What particular region was really driving that, if one was a standout?
China. I mean, 2 years ago, China was one of the worst performing countries This past year, it's been one of the strongest countries. Despite all of the tariff things out there, I think to a certain extent, Chinese equities were very, very cheap. And certainly in the technology sector, they were particularly cheap. And I think to a certain extent, the Chinese consumer is starting to spend again. But again, we're looking at, very, very strong numbers from China, Asia, Latin America. But you can see really it's double digits across the board on a year-to-date basis.
I made reference to the bonds earlier. And again, relative to stocks, maybe not as impressive, but relative to the bond market generally, especially over the last couple of years, these numbers are pretty strong.
Mm-hmm. One thing I'll point out is that municipals had a very nice recovery in the third quarter. Now they are lagging relative to other sectors on a year-to-date basis, but they were actually flat to down for the year prior to this quarter. So that was, a very nice increase. We mentioned spreads having come down, and so it's not hard to understand emerging market and high yields with those returns, but that also means with those yields being much closer to treasury yields, that if things weaken a little bit, that actually might be where you see the bigger risk.
Got it. Well, let's transition our discussion now from the economy and the markets to our outlook going forward for both. So as far as the U.S. economy is concerned, I mentioned the shutdown. With the shutdown, economic data is not really coming out. And you made reference to some of the private data sources. I think everybody's trying to do their best to kind of piece together where the economy is, but it is a little bit like driving blindfolded, or at least with one eye closed. So prolonged shutdown definitely could have some lasting negative impacts. We hope we don't see that. We hope the shutdown is not that long, but it certainly could. And I think everybody expects that even those that are impacted by the shutdown will get the back pay. It's just during the period in which they're shut down, there's a lot of hardship on those families for sure, and that could bring hardship onto the economy more broadly if it's too long. Tariffs, so far that's been pretty muted, Jonathan.
It has been. There's still a lot of debate, and we have a slide where we kind of go into that. I think some of it has been priced in finished goods, but maybe not all of it.
Yes. Okay. Inflation, it's gone, up modestly due to the tariffs. Generally it's actually trended down, but the tariffs are probably keeping it a little bit higher than it would otherwise be. Growth is slowing. You mentioned that, but heck, it's slowing from pretty high levels. So, we're not even really close to what would be deemed a true recession. Doesn't mean we can't go into one. True, but we're not there. And the Fed probably going to be cutting. We got tax refunds next year. Consumers holding up again, despite some of the concerns. AI capital spending is like crazy right now. So there's a lot of reasons to be positive, even in the face of a lot of reasons to have some concerns. International, solid growth there. No reason to believe trends aren't going to continue unless some shock to the system occurs. And monetary easing outside the U.S. is probably going to continue to occur. So you made reference to tariffs, though. So tell us, what is this slide trying to convey?
Okay, well, let's look at the August number under 2025. The effective tariff rate right now is estimated to be 11.3. This is from JP Morgan. Yale Labs is another source that has been looking at it. But there's a little bit of debate because some companies are switching codes and there's just a lot of changes going on. So we don't know yet, but that's kind of the estimate. And that's compared to essentially JP Morgan in this case is assuming that the September 30th effective tariff is 19%. It's going to be somewhere in that 15 to 19%. Some people have it at 15. But what we could see in the fourth quarter is that effective tariff rate from August continues to tick up. And this would be going into the holiday season. So that's why there's a little bit of concern about that.
Got it. And what is this telling us about then inflation?
Yeah, so let's look at the far right. You're going to see that in August, CPI was 2.9%. Now it is pretty small, but if you look at the orange within the last 2 to 3 bars, that's core goods. And that's what we've been seeing with the tariffs. And that's really probably 80% of the reason why it's come up a bit in the last quarter or two. If we look at the light blue, dining, recreation, and other service spending, that's been a little bit sticky too. And then we've also talked about shelter costs in the past, and that's been a bit more sticky, but it is still kind of coming down. So once we kind of annualize that tariff impact, what we're probably looking at is again, maybe approaching 2.5% again by the end of next year. Some say maybe a little lower.
What I find interesting here is, I mean, again, I know if this trend continues and it's on the upward swing, not good. But where we are is not that far from the target rate or perceived target rate. And it's not that far from where we were in like 2018 to 2021. You know, we're talking about 0.5%, maybe 100 basis point difference. I mean, I don't know. Sometimes I think the inflation is a little bit overblown unless, again, it starts trending upward more quickly.
Yeah, and I think part of that too was concern over the tariffs and the effective rates and what that would really do. And certainly there was a lot of headlines on egg prices earlier in the year. So I think it kind of caused maybe more concern than what we've actually seen.
Or at least seen yet.
Yeah,
that's fair. AI, oh boy. AI CapEx spending. So there's a lot of money flowing into AI right now.
Yes, and there's a lot of money flowing into AI private equity.
Yes.
But one of the things, and you've probably seen similar articles, is just the number of data centers that have been built in the last 2 years and the number that are projected to grow over the next 5 years. I mean, I've even seen maps of what it looks like today versus in 2020, and it's just really amazing because, again, they're being built close to where the usage is. So these aren't necessarily being built in the middle of the country.
Right.
And so there's going to be some NIMBY sort of issues, I think, in some cities. We've heard, I think it's Milwaukee, where there might be fighting one. But the amount of capital spending going in, if we look on the right side of that, you know, what we're looking at is communication, equipment, semiconductors. Those are going up, you know, very almost straight up. Even computer equipment is moving up. What we're not seeing, though, is that green, which is kind of flattish. So
it's funny that you mentioned that not in my backyard thing. I was down in, I think it was Farmington, one of the southern suburbs here of the Twin Cities, out in the country, and yard after yard after yard in the area that I was in said no data center, or say no to data center or something. And they had a big campaign. It looked like going, I didn't even know there was a data center potentially going in down there. But
yeah, and the new ones are big and they use a lot of water in the cooling process. And I think that's where a lot of the concern is.
So our outlook with regards to equities, October tends to be a little bit weaker. Q4 tends to be stronger. A little bit of a mixed message there, but that's just the way the data, results have shown and based on history. Corporate earnings growth, it's been pretty supportive of valuation so far, and we'll see if that continues. But thus far, we talked about valuations being high, but it is a positive environment. Downside risk for sure. I mean, we mentioned consumer, we mentioned the tariffs. We got the government shutdown. I mean, there's lots of things to have some concerns over. But international, that has continued to perform well throughout the year. We've had over the last decade a couple of short periods where international looks like it's going to begin to outperform, and it kind of duds out. But this one has been pretty sustainable for the year.
Yeah, it could provide a catalyst, but again, we'll have to see.
Let's talk about the dollar, because 1/3 of that international performance has been the weaker dollar. So what's this telling us?
Yeah, on the left, we're looking at the dollar cycles, and there's definitely been a correlation between a rising or falling dollar and international performance. And so when the dollar falls, that tends to be good for international performance. And so what I highlighted on the bottom is the fact that interest rates are coming down, but certainly outside the US, they are lower than in the US. And so if we start to come down, that interest rate differential will come down as well, which would suggest that the dollar could fall more.
Got it. Well, and back to the comment that I made earlier, in May, we get a new Fed chair, and that could push rates down further because probably more accommodative to the administration's positioning.
Absolutely. And so here we're again showing the periods on the top where we've seen the US equities do better than international, other side, where international has done better. And so we're potentially exiting a very long period with US outperformance. And in fact, if we look at the very end, you can't see it. Now, this is a 3-year rolling, but this is where we say that we think it's starting. But again, we'll have to ultimately see whether these factors continue to work in the favor of international.
So the dark shaded, whatever, again, I'm
purple in this case.
The purple being lower is US outperforming international. And we've had a long period where the US has outperformed. Even though this year, international's outperformed, what you're saying is we're using a 3-year rolling data set here, and you just don't even see it.
Other 2 years.
And the other 2 years were so strong, dominant with the US. Interesting. Well, let's talk about global earnings since we're talking about international.
Yeah, so I thought that was instructive to look at this, because certainly when we look at international performance this year, biggest factor has been the weak dollar, but part of it also has been valuation expansion, and they were relatively cheap. What I wanted to then show is what's going on with earnings. And so the earnings expectation for the next couple of years is actually positive. So, that's really honestly across the board, the US, India, Japan, Eurozone, and China. And so again, that should be very supportive for the equity markets.
Got it. So you have a strong outlook based on history. So this is looking at September's?
Well, what this is saying is that when we see new highs in September, that tends to be a good sign as we look into the fourth quarter.
Got it.
And so interestingly, the number of new highs in the S&P, in the new highs in September for the S&P, I can't remember the exact number. I think it was like 23. That was the largest number in like 25 years that we've seen. It's just, that has been how strong markets have been in the last quarter or so. And so what this is showing is that when we look at this over a long period, 1950 through 2024, 80% of the time the market is higher in the fourth quarter with kind of that average return of about 4%.
Of course, I'm always reminded that these statistics and averages work until
They don't.
exactly.
And 2018
Exactly.
was certainly a year where it did not work.
Right.
So
Right. All right. Let's talk about our outlook for the fixed income markets. And we really do believe bonds should continue to provide some stability in portfolios if we get into an environment where equities have some downside. And I know everybody still has on their mind the whole 2022 experience where bonds were negative. Now half as much as stocks, but they still experienced a pretty tough down year in 2022. But we're in a completely different environment. Remember 2022, the Fed was aggressively raising rates. And that really helped contribute to that negative performance where we're in a completely different position with the Fed now. Yields, they're pretty attractive with all that, hiking of rates that happened a year or two or so ago. And that then gets us to this, showing us the attractiveness of yields relative. So how do we interpret this?
So basically, if we look at the diamonds, that's kind of what the current yield is. And if you look at the horizontal bar in light purple, that's kind of that average. And I just wanted to highlight municipals. So again, very, very nice yields there. And I think they were so attractive in the last quarter that we probably saw some institutional crossover buyers, meaning the yield was high enough that even people who typically buy taxable bonds bought them because of that yield. So it wasn't just high net worth individuals who needed that tax break.
Got it. Well, let's transition our discussion now away from what we think will be happening in the markets and the economy going forward and our perspectives to financial planning in retirement. And the retirement equation, and the real focus here that we try and work with our clients on is keeping mind of what is totally out of your control. Like those things, and this is generally with life, at least my philosophy on life is, if it's that far totally out of your control, you really just can't worry about it. I mean, you can be aware of it, but you've got to also recognize that it's not within your control. Market returns. I wish I could dictate market returns, but fact is nobody can. Tax policy. I mean, me as an individual really can. I guess as a collective, we vote in who we think will pass legislation that aligns with our tax policy expectations, but individually it's very, very hard to control. Some things we can control a little bit. I mean, we put longevity here. I mean, maybe you have a little bit, maybe you exercise more, eat better, but
yeah, but it's interesting. We'll see it in the numbers on one of the slides.
Yes, yeah. So. But things that are in our control, saving, spending, asset allocation, I mean, those are completely within our control and really the areas where we need to focus the vast majority of our attention when we're talking about retirement. The key risk in retirement, obviously income replacement, longevity, and the risk there is you live too long, which is that's kind of a good risk, I think.
As long as you don't run out of money.
That's true. Good point. Medical costs, inflation obviously erodes the value of the dollar over time. Investment allocation, like getting too risky, right at the wrong time, or unplanned withdrawals. That's a big one that we see. Like, oh yeah, I'm on my budget, $5,000 a month, $10,000, $20,000 a month, and then you got massive replacement of a roof or taking the family on a vacation or something. Some things you can control, you can't, but that's a big risk in retirement is unplanned withdrawals. Outside of withdrawals, though, just generally, we got to think about what's the best tax planning for withdrawals. So what are we seeing here, Jonathan?
Well, what we're seeing is again, where you save your money versus where you take it out. It's not all created equally. And so you have to be aware of income taxes. So for example, your 401k and your IRA are not tax-free. They're tax deferred. So
Unless they're Roths.
Unless they're Roths, correct. So you do have to think about whatever you have saved in those, there's going to be some tax on that. You know, you have to think about Social Security and, you know, what could be subject to tax.
IRMA with Medicare.
Right, exactly. And so we have to think about all of that, and you have to have diversified sources. So buckets of, you know, perhaps Roth money, money that you're saving in regular brokerage accounts, money you're saving in qualified retirement.
So we talk about diversification with investments, but there's also diversifications with vehicles that then you make investments within. I think that's really important, and this is something that we discuss a lot with our clients, and the fact that you really have to almost do tax projections or some type of tax planning in order to answer the question of, should I take my money out of the HSA, or should I take it out of my Roth or my traditional IRA? You know, without having some tax awareness, it's very difficult to make those types of decisions. We did mention longevity. So this is a chart on life expectancy.
Yeah, and I hinted that you have a little bit of things in your control relative to your longevity. And so here we're looking at the longevity of non-smokers in excellent health versus the general population. And so on the left, we have women, we have men, and then we have at least one in a couple. So what you'll see is, let's look at age 90. And so if you're a woman in excellent health non-smoker, you have a 53% chance of living to age 90.
You're 65 today.
You're 65 today.
Yep, okay.
Yep, good point. Whereas if you were not healthy and you were a smoker, you have a 31% chance. And men, a little bit lower at 43% and 19%. But I think the one to really look at is when you're planning for your retirement. You know, the old adage was plan for 20 years. But with this, if you're in good health, you might have to plan for a little bit longer period. Because when we look at it at age 90, there's a 73% chance that one of two in the couple will live.
Got it.
And so you almost have to plan for retirement planning beyond 90.
Well, I mean, it's almost 50% chance to 95 for if you're married and you're in a couple. I mean, that's almost 50-50 there. That's pretty astonishing. And frankly, these numbers, with the advent of what's happening in medical technology, my assumption is these percentages are just going to get higher. They're probably not going to get lower.
Right.
And of course, this brings us to healthcare costs. I mean, this was one of the risks, right? Medical costs, because they tend to increase well above any historical inflation rates. And of course, the changes in spending over time. You know, we have an old adage: you've got your go-go years, right after you retire. You're traveling, you're doing all the things that you didn't have a chance to do, maybe buying a second property, et cetera, et cetera. Then you got the slow go years, right? Connecting with community, family. And then, you know, later in life, maybe the no-go years where, you know, you just don't have the energy, interest, et cetera. So we see this fluctuation of spending throughout kind of a phase of life. And then, of course, aligning your particular investment portfolio with your goals based on the the phase of retirement you're in, go, slow go, no go years. That's super important as well, because we used to be able to rely upon like pensions.
Mm-hmm.
Like you didn't really have to worry as much about managing a portfolio because the company you worked for maybe 30 or 40 years, they just pay you every month,
Mm-hmm.
right? And that's how you manage your money. You got your kind of paycheck, the pension, and you spend it, and you stayed within those kind of thresholds of cash flow. Now we have to do more of it ourselves because pensions are just not what they used to be.
Mm-hmm.
Pretty much non-existent for most of those certainly under 50. And when you do that and you're managing these assets yourself, we at least here at SilverOak use a bucket strategy. We try and maintain enough cash reserves so that if there is a massive downturn in the market that is prolonged, you're not having to sell at an inopportune time. So we think about these different buckets, and we have another illustration of this bucket strategy in a few minutes.
Yeah, so let's talk about the withdrawal approaches. So if you think about a portfolio, in financial planning, there's kind of the rule, 4% withdrawal rule. And what we're looking on the right side is kind of at different asset levels, the percentage of that working. But I think what's really important is on the left side is that the 4%, generally speaking, works fairly well. Not perfect, but that's at 4%. What happens if you withdraw at 5%? All of a sudden, you're very, very tight. And then at 6%, your savings would only, investments would only last 20 years. And we just showed you that you probably have to plan for 25 to 30 years.
Yeah. So you did all that time accumulating and saving, and you use this bucket strategy, but now you're taking out of the buckets too much. Only, from 4 to 5 to 6%. I mean, those aren't big percentages, but it goes from pretty much no problem to, oop, we got a problem.
And so what I will say about that 4% rule is certainly it's a guide, but you need to be a little bit flexible. And so we really talk more about flexibility and kind of the idea when your portfolio has done really, really well, maybe that's the year you splurge a little bit and take a little bit more. But you certainly want to guard against doing that if we're in a bear market.
Right. Well, and this next slide is, I found anyway, super interesting, because this tells us, like, hey, if I got an average return of 5%, or use any percentage, 6%, 8%, 10%, the amount left at the end of, in this case, it's 30 years, at the end of 30 years, is highly dependent, not on the average. Like I could earn the same average 5%, but it's on the sequence of those returns. So if you look toward the bottom or maybe the middle of the screen, you have the bars. And what color is that?
Purple.
Purple. So you have the purple bars. Well, that is a 30-year series where we start the series with good performance and we end with bad. The one right below that is just a steady 5% every year, which isn't going to happen. Guarantee. And there's not a lot of guarantees I'll give. That one, I guarantee is not going to happen. We never get averages.
It's kind of like the weather. The average
Exactly.
is the variability of the day-to-day.
Exactly. At the bottom, though, you're starting that series with a bad year. These all average 5%. But the ending dollar amount is materially different. And at the top, you'll see that at that series that's not as favorable, where you start negative, you actually end, 8 years? You run out of money 8 years sooner than you would otherwise. And actually probably even more than that, because at 30 years, you're still left with money in those other two more favorable return series.
Yep. And again, as you mentioned, at the end of the return series, it's actually very nice returns, but you have a small amount of money.
Exactly. Yeah. So sequence of returns is so important, but it's something that is not totally in your control. You can control the risk profile, maybe how much downside risk you have, but you can't control the stock market being down the year you retire. I mean, if that happens, that is just, you know, an unfortunate sequence of returns. We have mentioned cash flow a couple times. We talked about withdrawals. We talked about safe withdrawals rates. You know, again, getting back to these cash reserves, though, we like to have 12 to 24, maybe even as much as 36 months of cash reserved to accommodate non-routine expenses as well as kind of the monthly routine expenses. And these cash reserves, they're kind of off to the side. So we think about the bucket approach, and we think about, oh, you've got your portfolio over on the left, your investment portfolio. That's where you have stocks and bonds. Maybe you got some liquidity for cash reserves. Every 3 months, every 6 months, you replenish this cash reserve because every month or so, money's coming out of that to go to your bank account to pay your expenses. And this is just kind of a ongoing process of always looking at your cash reserves, making sure that you're aligned with your financial plan, you're not overspending, and you've got liquidity in the event that there's a pullback in the stock market. You know, a lot of our clients, not all for sure, because some take more risks than others, but again, we try to keep for our retirees 12 to 36 months of liquidity, plus they have their bonds. So if the stock market's down a lot, they're probably safe for 5 to 6 years if we really had to wait that long to sell equities. And that's a pretty long period of time. I mean, typically the recovery period is what, 3.7 years to get back to break even?
Although in the last 5 years, it's been faster than that.
A lot less.
But we can't count on that forever.
That's a fair point.
And the other thing too, just to think about that, is you mentioned the idea of a paycheck. And so setting up that periodic transfer to your bank account, whether it's monthly, quarterly, or so forth, that's really kind of how you get paid in retirement.
That's a fair point. So retirement readiness action plan. And again, this hopefully is more for folks on the webinar that aren't working with us, because if you're working with us, we're probably doing this or should be doing this for you, at least if you're in retirement. But estimate your retirement needs and expenses. I mean, I can't tell you how many people that we onboard that are retired and yet they've never really gone through this process, and they have concerns. Do they have enough money to last? And we can't really answer that unless we know what you think your needs and your expenses are. Doesn't mean budget, just needs, you know, means that we need to know. Assess your income sources, right? Social Security, pension, your investment portfolio. Plan for healthcare and long-term care expenses. We talked about that. Develop an investment strategy, not just develop one, but one that's in line with meeting all of these goals and objectives. Develop a withdrawal strategy, which ties into the investment strategy. Review and adjust your plan. Like, don't do this and put it on the shelf and like at the end of retirement, you know, think, oh, did I make it or not? I mean, if you run out of money, that's a little too late. And don't forget in the process, don't forget about estate and incapacity planning, because if something happened that shortened your life or that shortened the quality of your life, and you became incapacitated, you really need to be cognizant of that and have a plan. In the last couple updates here, well, one, finally, tax season is officially over because it's October 15th, which is the deadline for extensions. As far as IQs goes, that's our investment quality scoring system. Performance
has generally been good. The one difficult area has been small cap.
Yep.
International has been exceptionally strong. Large caps have done generally very well, and our bond funds have done very well.
Okay. We have added one position to our recommended list as well since our last webinar. We had 2 removed from the recommended list, not necessarily for performance. I know one in particular was because of complete kind of restructuring of the global team and specifically of the managers on that particular position. And we've had 2 positions that have been upgraded and removed from the watch list, so they have been deemed higher quality. As far as SilverOak updates internally, we continue to build out our space so that we have more team members in the space for them to be in office. And we continue to assess our technology, in specific, even our AI resources that we want to utilize. And of course, year-end tax or year-end reminders, one being keep good tax records. No time better than the present to start if you've not necessarily had great habits with keeping tax records along the way. Now's a great time to start. Do a tax projection. We talked about how important that is for a number of reasons. Look at tax loss harvesting, although
There aren't going to be many.
yeah, there's not going to be that much there, which is the good news.
Right.
But from a tax perspective, maybe not so. Watch for year-end capital gain distributions. Those are going to be posting in the next couple of months. And make sure that you get any year-end charitable contributions made. Don't wait till the very last minute because they may not get processed by the 12/31 deadline. For us, we'll do everything we can, try and move heaven and earth to get them in, but some of that is out of our control. So just a reminder, if you have any additional questions or topics that you would like us to discuss at one of our future webinars, please reach out to your advisor. If you're not working with an advisor, you can reach out to me directly, and I would be happy to speak with you. So again, thank you, Jonathan. Thank you for the rest of the team. And thank you everyone who attended today's webinar. We really appreciate your participation and hope you have a great day.